Hello, everyone. Welcome back for another market live update, a call to action, a continuation of last week's conversation we had about a week ago, yesterday, where we brought in some of our frontline analysts to talk about this, another crossroads that we're facing as we've continued to see the turmoil and the volatility persist. I've decided to bring another guest to us today that's we like to call the next all-star, if you will, someone that we've been watching from a distance with some of our folks that we know that I'll introduce in a moment. But before I do, those of you that are joining us for the first time, Fratarcangeli Wealth Management has been around. It'll be 30 years this December. We are an independent practice that works with a very select group of clients, and we do more than just manage wealth and money. We look at all aspects and attributes of our clients' personal as well as businesses. 80% of our clientele are entrepreneurs, business owners, public and private companies, and executive groups that are attached. And we have a nice, call it, aspect of our business that has a history of working with athletes and entertainers and helping guide and counsel them through a little shorter career and how to make sure that they protect themselves. But we do more than just manage wealth. Our role here at Fratarcangeli Wealth Management, which has over 250 years of experience with over 30 professionals, is to understand both sides of the balance sheet, all the complex issues that these individuals and companies face on a near-term basis, as well as a ultimate long-term and legacy basis, and understanding both sides of the balance sheet, understanding their estate planning personally, their goals relative to protecting their wealth today, as well as through the next generation. We also look at the, call it, liability side of the balance sheet, whether it's for lending needs or possibly having an investment banking or an event that we can help guide and counsel them with, and utilizing our leverage network that we've been able to learn from and see the outcome and essentially work with over the last several decades, and just really understanding all the major issues that come up over time when we look at their other aspects of their, call it, liabilities and their, call it, fixed costs that we've seen some major changes over the years with heavier cost and inflation that we're facing today. So it goes far greater. I would look at us as financial bodyguards, understanding all that is important to you personally and your business and your family, and being there to make sure that you're aware of all the maybe blind spots as well as potential pitfalls that you may run into, so that you don't have to learn the hard way. We can guide and counsel you through those decisions that can take into consideration all potential outcomes and make sure that you're well versed in understanding of what your choices are. And that being said, here we sit today facing over a 30-year career. I've seen a lot of different things. It's always unique in its own right, but it's similar in many ways. And we have this market that has had a week where we've had 2 days where we had the largest drop in the market in over 25 years. And it certainly has created a sense of uneasiness, maybe even a little bit of panic. And I'm looking to get some input from some folks out there that I've watched and gotten to know. And I'm looking forward to understanding their point of view. And our platform here at Fratarcangeli Wealth Management has a very deep network in a number of different places, and the front lines of the call it economist views and the different sides of the research we lean on occasion. And today I brought with us today Andrew Opdyke, who's a certified financial analyst. He's a senior economist here at First Trust, someone we've worked with for many years. He's ranked one of the top forecasters of the U.S. economy over the past several years. As I like to say, he's a up-and-coming all-star. He is responsible for analyzing economic indicators while writing economic commentary and producing articles that come out of First Trust in his economic blog. Andrews regularly presents economic commentary to financial professionals in different publications. He has an MBA out of Northwestern University, Kellogg Graduate School. And I understand that you're from Hope College, which is in my home state of Michigan. And I have some folks that I know graduated from that private institution that's exceptional. And it's just an honor to have you here, Andrew. And I'm interested to bring a new guest on our typical live market update call to action, some new fresh blood to get what your perspective is. And, here we sit today in a very unique time, and yet we feel like we've been at these points before. And I'm curious as to your view on the market conditions. And as we digest the tariff evolution and negotiations, What do you see as both a favorable outcome and a potential negative outcome for both the global trade as well as the domestic and foreign markets?
Yeah, Jeff, that's a great question. Thank you for having me on, and go Dutch, go Hope. It's obviously that we're living in a time of a lot of uncertainty. And as you mentioned, right, we've seen some very volatile movements within the markets. Yesterday, intraday market movements were very substantial. We kind of were coming off of what was 3 days, one of the most volatile periods we've seen since 1987. Now we're going to go back and look at history. We are the team that I work on. We are the number 2 ranked forecasters for the U.S. economy globally. We've been in the top 5 for the last 10 years. And we really believe that math, history, can tell us a lot about where we stand today and where we go into the future. Emotions always rise in these types of environments. And emotion is something you certainly need to acknowledge, but oftentimes, particularly when we see this from a market standpoint, emotions are something that can get you in trouble if you let that dominate the thought process. So here's what I want to do. I want to walk you through, I'm going to put up a couple slides on the screen, and I want to walk you through what we're looking at from the data perspective. And I'll tell you, coming into this year, our forecast, I think we were one of the only people that was out there on the market saying we think that this could be a bit of a turbulent year and a down year for the markets. We called this year the year of promise, right? There's a lot of discussion, the extension of the tax cuts, deregulation, some reform in Washington, but along the way, we were likely to see some difficulties. Now, you mentioned, what is kind of the big downside risk? What is everyone concerned about with the tariffs? The thing I keep hearing, and by the way, what I do day to day, I do a lot of writing, a lot of research, but I also spend a lot of my time traveling. I'm out talking with financial advisors. I'm out talking with people like your clients. I spend a week each month just traveling to meet with owner-operators, small, mid-sized Fortune 500 companies. I've also spent a lot of time this year sitting down with groups like the National Society of Structural Engineers, the Copper Council, the Iron and Steel Institutes, to understand how they're viewing this environment. They're at the center, they're at the core of a lot of these discussions. How is this impacting them? Well, when we go back to history and we think about what are the traumatic events, when are the times in history where we've seen the biggest impact, biggest downward impact from tariff-related activity? Well, the one that comes to mind as an economist is the Smoot-Hawley Tariff Act going back to the 1920s. That was one that people say that led to the Great Depression, obviously a significant, severe economic event. But I'll tell you, when I think about the downside situation here, I don't think they're equivocal. If you go back to the 1920s, this environment that we live in, the chart that's up on the screen right now, looks at how we consume as individuals. What do we spend our money on? Where do we spend our time? Today, we spend about 70% of our resources on the service side of the economy. If you go down to the goods, that's about 30. This is the exact opposite of where we were close to 100 years ago. There, we were a goods-dominated environment. They were about 70%. Services were 30. But let's think about what is the potential significant downside. Let's put that worst case scenario out there. We've got 30% of the economy tied into goods. And if we break that down a little further, what percent of that is tied into foreign goods? Well, that's about 15% of everything we purchase. Now, there's a couple of groups that have been exempted from the tariffs. Canada and Mexico, who we'll talk about in a minute because they may give us some guidance into where we go from here. We've already had a month, 2 months of negotiations with our 2 largest trading partners. But if we take those 2 out, and then we also think lumber's been exempted, energy products have been exempted, copper has been exempted. There's a number of categories. What you find is it's about 9% of all purchases have some exposure here onto that foreign goods side of the economy. Let's assume for a moment that completely goes away. Okay, that would be beyond the worst case scenario. If we just completely stop buying those products, we're completely unavailable. During that 1920s time period, which was the biggest pullback in international trade we've ever seen, we saw about a 60% decline in activity. If we were to see 100% complete elimination, it would put us into a recession. Now, there's reasons that a lot of other countries want to avoid any situation approaching that. We are net buyers in the international economy. We buy more from international than we sell to them. And this is part of what Trump is talking about, part of his concern. But let's think about what is the reasonable. If 60% is the biggest that we saw with Smoot-Hawley, and again, 9% of overall, if it's that case, then we're talking about 5% impact on the economy. If we go back through the last 70 years, go post let's say, the Great Depression, what we typically see during a pullback, and we have examples. We got 1971, where Nixon went in and put a 10% across the board surcharge on every good, every service, no matter where it was coming from. During those environments, the impact tended to be closer to 20, 30%. If we were to take the high end of that, 30%, we're talking about 3% of everything that we consume. Now, how deep is this likely to go? The major question there is, what is President Trump prioritize? And this is, I think, the $1 million question that we're going to get a lot of information on here over the next 3 weeks. Okay, when he came out and said, I want to do reciprocal tariffs, what I want to do is get on equal footing with the rest of the world. This was the kind of chart that I was looking at. Right here, we've got the US and our 10 largest trading partners. And what stuck out, I think a lot of people were talking about, we don't want the US to raise tariffs, and China's going to come back and retaliate. Mexico's going to retaliate. Canada's going to retaliate. Let's acknowledge from the starting point that the US coming into this had the lowest tariff rates among all of our major trade partners. And the initial discussion was, look, you've got a place like the EU. When the US sends a car to the EU charges us 10% tariffs to bring that into the European countries. When they would send a car to us, we said, okay, we'll charge you 2.5%. And the initial discussion was, why don't we get on the same page here? You can come down to 2.5 and we'll stay there. If you don't want to do that, then we'll come up to meet you at 10. What we want to have is fair trade in both directions. We want to be playing by the same rules. Now, the discussion that happened last week when he came out, Trump came out in the Rose Garden, said, we're going to put these kind of astronomically high numbers. He has a tendency, as we've seen through the beginning of this term and his last term, he likes to escalate to negotiate. Go back with me to February and March of this year. That is when we did put the tariffs in place on Canada and Mexico. And if you remember, this was kind of a shocker because these are two of our biggest trading partners, a group that he had put in the USMCA, US-Mexico-Canada trade agreement during his first administration. Now, during those periods, he put it in February, put 25% tariffs. For those of you out there that remember, it was really in effect for one trading day, about a half a trading day. The Monday it went into effect, what happened? Well, Mexico called and Canada called and said, what do we need to do? When Canada exports from their country, okay, about 75% of their exports that leave Canada come to the United States. For Mexico, it's a similar number, 75, 78%. They have a heavy reliance on the US. And they said, look, if you're serious about this, right, you want to get some better trade agreements, here's what we're going to do. We're going to come towards you. We're going to move in that direction. Now, they started it, and Trump said, look, we're going to put off then for a month. The whole impact lasted about 4 hours the first day. They said, we're going to wait another month, and we're going to see what happens. Let's see how much progress we make. Beginning of March, we put those tariffs back in place on Canada and Mexico. And then again, they had that negotiation. What we kept seeing was this movement towards freer trade. And this is something, as I'm hearing from countries, from organizations, what we hear is that there are 20, 30, 40, 50 nations right now that are queuing up. Japan is at the lead of them, saying, we want to have this discussion. And if the direction that we ultimately move is towards freer trade, which I think is the most likely scenario, maybe I shouldn't be so. China, we have an ongoing conflict with. China, right? There's further escalation talked about today. China, I kind of understand that as beyond this scope. China's had this misunderstanding of copyright. They thought it meant the right to copy. And so there's been some disagreements. There's been more discussion on rule of law. But if we see this movement in this direction, I think it's at the end of the day, through the volatility and unabashed positive. The concern is, what if Trump's priority is to just completely balance trade? Say we're going to send the same amount to Vietnam. They need to buy as much from us as we buy from them, in which case this can go on for longer. But let's go back to history, okay? Because there's been multiple situations in the past. 1971, again, with Nixon, 1981 under Reagan, when we started putting things on international autos, 83, those expanded to other products. I want to take a minute and go back through history to see how much it impacted. Okay, so what I have here is the annualized returns 1928 through 2024. Let's look at a couple of those prior time periods where we did have disruptions. We did have uncertainty. They've tended to be relatively short-lived. And as I'll show you in 1 minute, right, the return afterwards as we get clarity, we've tended to get progress after that pain. We've tended to move towards freer trade, and the market impacts have been notable. Let's find on here 1971. Well, if we go back and find 1971, the year that Nixon put those trade barriers in place, and again, his conversation back there, if you go back and look at and read the newspapers and listen to some of the recordings, the argument was we have unbalanced trade. They're manipulating their currencies. They've got too many restrictions on the US relative to what we have. There's a lot of echoes. Now, you notice that year, the market still returned 14.3%. Some people said, well, maybe it was a delayed impact and it hit in 1972. Well, here's 1972. And in fact, the markets moved even higher. What about in 1981? Because you can find that is over here. And in fact, the market did move down that year. In fact, it moved down by a similar amount to what we saw in 2018. If you remember 2018, this is when we put the China tariffs in place during Trump 1.0, steel, aluminum, hitting different categories. But again, what I think you need to do is you need to look back through history and say what happened immediately and what type of opportunity did it create. If you go from 1981 and then say, how did we progress as we figured things out? Well, 1982, 21.5% return, 1983, 22.6% return. And that 2018, which again, it was very people were anxious. We hate uncertainty. Companies don't like uncertainty. They want clarity. They want to make business decisions with a confidence that over the next 3 years, 5 years, 7, 10, the rules that are in place will be the rules that remain. But again, even that time period, 2018, what do we see? Well, 2019, we got 31.5%. Now, this also reminds me, because I started to follow through, look at 1 year, 2 year, 3 years after. This year, I think, is one of those times we have to look back and remember that no matter how much uncertainty is there, right, a lot of things can happen behind the scenes. Just think about 2020. That, to me, is an incredible example of uncertainty. We're going into earnings season here. Starting in the next few weeks, we're going to hear companies have to try to make this forward guidance. Where do they see things moving between now and the end of the quarter, now and the end of the year? One other time it was nearly as uncertain. I mean, if not more uncertain, back to 2020. Now, imagine if somebody walked into a room with you on 12/31 of 2019 and said, Jeff, I'm going to promise you, I can guarantee you that over the next 12 months, we're going to see the two worst months we've ever seen on the employment market. We're going to lose 24 million jobs over the span of 2 months. And we're also going to see the two largest pullbacks, 2 months of economic destruction, the likes of which we haven't seen since the Great Depression. And by the end of the year, we're still going to be down 10 million workers. And by the end of the year, people will not yet be back out and traveling. We're going to be going home. We're going to be shutting the doors. The restaurants, the bars, the airlines, the hotels are going to have the worst year for activity that they have seen in most of their existences. And then I came to you and said, Jeff, how do you want to invest that year? I don't think too many people would have been like, oh, that sounds like the type of setup that can get me 18%. During that time period, right, we had massive volatility. In fact, in most of the years that we have here, you have 10% pullbacks. That's relatively normal. I think what we're seeing right now is a bit of that reset. But what drives us? At the end of the day, one of the critical drivers is earnings. And this is one of the things that's happening behind the scenes coming into this year. We have a 12% earnings growth. Now, I do think this number is going to come down. But I also want to bring in here, this is U.S. earnings, and you'll notice they kind of go here from the bottom left towards the upper right. As we go further into the tariff time period, consider what the rest of the world is seeing. Here is the rest of the world excluding the U.S. Okay. Let me go back. Here's the US, bottom left to upper right. We start at about $50. It goes up to about $260. Okay. And then you look at the rest of the world, they start at 50, they go to about 150. We obviously have moved much faster. This is one of those considerations. And this is, I can guarantee you on the administration's mind, but a lot of these countries are saying, the US has been the growth leaders here for the last 10, 15, 20 years. The US has been dominant on technology. If we are going to disassociate ourselves, if we're willing to say, yeah, if the US wants to have higher tariff rates, if they want to put the same tariff rates on us that we put on them, maybe we're going to back this thing out. It's going to have traumatic impacts on their local economies. And I really do believe because of this, you're going to see a lot of groups come to the table. Europe has already, the EU came and said, look, we're willing to do 0% tariffs. If you want to do 0% tariffs, and we both agree on both sides. Now, Trump came back and said, you also have to do it with quotas. You also have to do it with restrictions. This isn't just that top line number. We want free trade. there's a heavy incentive here for a lot of people to come to the table. But I want to notice one other thing. Okay. And this is going a little bit beyond the markets, but let me say this and then I'll pause and we can talk about any questions that you might have. A lot of people are worried about the inflation impact, right? Obviously, over the past 5-10 years, particularly last 5 years, we've seen major changes in inflation. And there's a concern here that the tariffs, even if we get resolution, are going to cause some inflation problems. And I'll tell you, I don't believe that's going to be the case. And here's why. Okay. I want you to understand what drives inflation in economies. And in order to do that, right, I'm going to take you to an imaginary economy to simplify things, to help understand how prices move. So imagine for a minute that you lived in a world with only two things. You had $10 and you had 10 apples, right? In this economy, how much is an apple going to cost? Well, you run the math in your head and say, that's $1 per apple. That's not too hard to calculate. Now, when we went through COVID, and some people have worried, we went through COVID, that inflation was, it impacted my nest egg. This impacted the price of all the things that I buy, the cars, the house, the food, right? I didn't like that inflation. That was uncomfortable. The Fed had to raise rates substantially to get it down. Well, I'll argue the reason that we had that, the reason we saw the notable inflation back then was because two things happened. We added money to the system. We went from $10 to 13, and we also saw a decline in the output. If you remember turning on the TV back in 2020 into 2021, and you heard about the Port of Long Beach with 111 ships waiting offshore, waiting to dock and unload. That was a tough environment. When the world moved from the outside inside, the inside online, it had dramatic impacts on the economy. Now, the Fed said, don't worry about it. If you remember this, in 2020, the Fed was saying, oh, no, it's transitory. You're not going to see any inflation. Yeah, I mean, if you have $13 and 5 apples, that's a big shock in price. But here's what's going to happen is the apples are going to come back. We're going to get 6, 7, 8, 9, 10. And when we do that, this price is going to go down. And that is, to a degree, what happened. Because as we got the apples back, right, we got back to 10 and the price came down, but we didn't go back to $1 per apple because these dollars were still here. Now, that caused inflation. The money in the system caused inflation. Supply chain disruptions can cause inflation. But here's what I want to do is I want to go back to this initial scenario and I want to think about how tariffs impact. And again, we've gone back through history. We've gone through the 70s, the 80s, the 90s, the 2000s. We've seen trade disruptions, tariff disputes under essentially every single presidency going back 70, 80, 100 years. So here's how I want to understand the tariffs. Let's say this apple is a car. And this is an example that Ford has brought up. The president's brought this up. The Federal Reserve has brought this up. They said, well, what happens if you put steel and aluminum tariffs in place? What happens if you put tariffs on Mexico? The price of your car is going to go up. And I agree with them there. But we have to take this one step further. Let's say the price of this car goes up $15 or 15%. We're going to go 15%. Okay. If it's 15% higher prices here, and I told you, Jeff, you have to buy this car. People point to it and say, well, that's inflation. And that's what I'm concerned about. I don't want to see the price of the car, the price of the house, the price of the eggs, the price of the guacamole go up. But we need to think about both sides of this, Jeff. If you have tariffs, right, that push up the price of that car 15%, is your income going to go up 15% to match that? And the answer is no. If it was, most people wouldn't be that upset about what was taking place. They would just say, well, I'm paying more for it, but my quality of life hasn't diminished. What people are concerned about is that their incomes aren't rising at the same pace as something like that car. But now we have to think about these other 9 apples. Because if your income doesn't go up at that same pace, we have to look back and say, well, are you going to make substitutions? Are you going to pull back in other areas? If you're not going to spend out of savings, which historically people don't do, if your income didn't go up, you're going to see offsets. And a lot of people forget this. If you don't dive into the data, right, this is the concern, is that areas like leisure and hospitality, areas like travel, and we're seeing the early signs of this, we start to pull back on those to pay for the things that we need to buy. So when I look out, Jeff, and we think about the market impacts, again, history tells us we tend to overreact and then we find our footing and we progress forward. History says that we tend to get these disruptions and we learn from some of those mistakes and we end up moving towards freer trade. Worst case, we don't do that. Worst case scenario, this gets locked in for 2 years, 3 years through the remainder of this administration, and we completely separate ourselves from the world. I don't think people want that. I don't think voters want that. I don't think that most of the people that are in the White House want that. Quite honestly, I don't think Trump wants that. If it did happen, you would see the U.S. go into a recession this year. It wouldn't be as deep as COVID. It wouldn't be as deep as the financial crisis, but it wouldn't be comfortable. The best scenario is that we, tonight, tomorrow, these other nations come and say, look, you have been the lowest tariff rates, and we will come down to meet you. Maybe they say, we want to go down to 0%. The reality is going to be somewhere in between. I think, again, that at the end of the day, what you're likely to see as we progress through the year is more and more countries moving in this direction. And I think what you're going to see, with some exceptions, whether that's China, whether that's areas like Russia, there's going to be some exemptions to that. But what I think you're ultimately going to see is that this momentum that we've seen, this integration that we've seen, this leadership we have here. And let's remind ourselves, we're 4% of the world's population producing 25% of the world's output. We are the most productive nation on the face of this earth, and we are center, we are core to a lot of international transactions. I think what you'll see, and I think it'll start here later this month, is a little bit of clarity, a little bit of calming, and a little more focus on how do we grow together, right? We had some disagreements. We kind of let things sit. We let those tariff rates remain where they were, but let's get serious and let's progress from here. It's going to be somewhere in between, but from a market standpoint, if I'm sitting there today, I get being worried. I get being concerned, but I will also tell you high uncertainty during periods of uncertainties when we've typically seen some of the best opportunities. So that, from an economic, from a market perspective, high level, that's what we're seeing today. Now, obviously, we could dive deeper in certain categories. We could look at the Fed and what they're going to do. But when I step back and look through history, that's the best guidance I've got.
Outstanding. Very good. I appreciate your cutting right through it, getting to the facts, getting to the variable outcomes that we could potentially be facing, best case, worst case. What I'm hearing is do not let emotion drive your decision making, which is the absolute first step in making sure that you're aligned accordingly to what is appropriate for your objectives. What is your intent? Stick to the focus of what that intent is, and don't let emotion, greed, fear drive you selling at the worst possible moment. And, as a kind of call it financial quarterback and bodyguard, I've had to have those conversations more so in the last 4 or 5 days than I had in the previous 4 to call it 5 months. So that's well received, and I appreciate you attacking that first, because we need to move that out of the way. And then you started getting into what has happened historically. What have we dealt with in this exact environment? It's a little bit unique. It's a little bit more broad. It's a little bit more deep. But we're also dealing with the bully on the parking lot that everyone knows is coming. And if you don't throw a punch, you're not going to be considered the bully much longer. You have to be able to stand your ground, unfortunately, to get the outcome that we believe he's intending to ultimately achieve for, we believe, the better good of our nation. So that being the case, he had to take it a step further. What I also heard you say was, worst case scenario, here's the outcome. We have a lower amount of capital from our income in order to do the things that, by the way, I can't remember the last time I was able to buy a ticket on a commercial aircraft that there wasn't a $1,500 one-way ticket price, because there was no seats available. So a few less people on that plane might be better for inflation that you're predicting is going to be not as quite an impact that people are predicting tariffs can be. But the fact is, that is what would happen worst case. What I'm hearing you say, which without having a conversation with you, Andrew, I've been saying the same thing for the last, call it 3 trading days. You have the worst case, you have the best case, and you have somewhere in between. And that's where you're landing. We're having a negotiation with these different leaders. And it sounds like many of them have come to the table, setting China aside. I think we all know that's a different, call it negotiation, that we hope and pray for the best outcome for all parties, but ultimately fair and free, call it free trade is what we're hoping for. But the reality of the situation, somewhere in between, puts us as a nation in a better situation relative to taxes being collected, exports and imports, and what is left behind for the folks here that are either paying for them or actually producing them and shipping them. So I believe that to be accurate. The uncertainty that the market does not do well with. We had a situation that I talked about last Monday, where we had a company report earnings, beating the expectations on the top and bottom line, and also guiding better. And yet the stock ended up down 12% that day. It's a retail stock. And I couldn't understand what was happening once I got to the understanding that 40% of everything on the shelves of that particular retailer was coming out of Mexico. And what the market basically did, Andrew, is it priced in the 25% tariffs on those 40% of goods, assuming that the profits that those would be creating would come right off the bottom line and the top line, and that's what the stock earnings would be. But the reality is that's not highly probable. There's going to be some pass-through of that cost. There's going to be some shifting and manipulating where they get those 40% of goods that may not come out of Mexico, but yet the market is pricing in worst case. So what can that create? What did Warren Buffett say? Bad news is the best news for investors, right? And that's the way we want to unemotionally look at this. And I have to ask the question because it's really at the top of our discussions around the office and with some folks like yourself. In recent days, many business leaders and CEOs, such as Bill Ackman, Ken Griffin, and Ken Fisher, have spoken out against tariffs and the plan for tariffs, while Senate is attempting to restrict the White House's role. How do you feel that this will impact these leaders and the outcome of the market volatility and ultimately objective at hand for what I believe is trying to be ultimately executed upon?
Yeah, it's a great question. You know, there's a lot of people that are speaking out. There's a lot of business owners who are looking at this. History tells us that tariffs are not the most effective tool. But as you mentioned, right, the U.S. has been footing the bill far more than its quote unquote fair share. If you look at U.S. spending for defense in places like Europe, quite frankly, what it's allowed Europe to do is by the U.S. spending more, the U.S. having lower tariff rates, it's given an advantage, which we've looked at. We've been doing this since World War II. Essentially, it was U.S. was in the best shape after the war. So we kind of made concessions to other countries, said, well, we are, not having as far to recover. We didn't have as much damage domestically. We're going to allow you to protect your goods, protect your services, get a little bit faster growth. Well, as we got further along, we just kind of fell into that momentum of the U.S. is always going to be the lowest. The U.S. is always going to pay more. The U.S. is always going to do this or that. I get it from a corporate standpoint. I personally believe I don't like tariffs. I don't like tariffs over time, but a lot of this is posturing. And if Trump comes out and says, hey, even when the people that have supported me so far, the people that have funded, the people that are running these corporations, even when they tell me they don't like this, I'm going to stick to the guns because I think it's right. It puts this in a position. If he starts signaling very early, you know what? Yeah, I'm going to back off on this thing. I'm going to delay it for 30 days, 60 days, 90 days. It weakens his negotiation position with other countries. And if we know one thing, it's that Trump's a negotiator. So he's going to hear that. And I think eventually you're going to start to see some of these concessions come through. And here's the other thing. You get this snowballing effect. Let's say Japan, who's going to be at the front of the line, Japan comes in and they get 2.5% rates, 2% rates, some notable decline in the tariffs, and we come to some agreement. Canada and Mexico come to agreements. What other nations start to see, Germany sees, France sees, is that if you have now some more certainty with Japan, if you have it with Canada and Mexico, and you're a Fortune 500 company, you're an international company, and you're looking to build a facility in the US or otherwise, your scope of where you can place that to engage with the United States is based on these nations. And as soon as one country does it, the others start to have to look at it and say, well, am I going to keep fighting this thing? Am I going to keep trying to have my higher tariff and I want theirs to keep theirs lower? If we start seeing enough countries move away from it, they start to come to the table too and say, we need to play by the same rules. So here, even Elon came out and said, Elon is in there. Elon's doing stuff with Doge. And quite frankly, I like a lot of the stuff that's happening behind the scenes because I think a shakeup was necessary, but he's got to stick to his guns. President Trump's got to stick to his guns here for a little bit longer. I think hold out for a little bit longer to show how serious he is. And I think that if he does that for a week or 2, 3 weeks, even with some of the market downturn, some of the market pain, it shows those other countries, no, you really need to consider this. You really need to step up. You really need to have this discussion. And again, I think we will get that movement. I think we will see that progress towards freer trade, towards a better trade environment, but it's the pain before the gain. And we saw this. We've seen this in the past. We saw some of this pain in the early 1980s under Reagan when he was doing the reset. Sometimes, if you can give so many different analogies, you do the work in the early parts in order to get that benefit over time. If you never address the problem, if you just let it sit there, you let it fester, you let it keep digging away, we can be on better footing if we take that pain now. And I think we will be.
That's well put. Once again, getting right to the granular aspects that most people, I think, are grasping the information properly. But I guess I have to ask, as I sit here and really want to make sure we're protecting our clients. I'll get into how we position ourselves for these exact environments. And it's not a matter of if we face these situations, it's a matter of when. And have you prepared yourself for being able to get through it? And I ask that question, one, for my my role in guiding and counseling clients and making sure we have enough liquidity, et cetera. But now I'm going to pose that question as it relates to the automotive industry or the manufacturing industry or folks out there that are sitting at the helm that I have the opportunity to talk to and ask them what they're doing. And what I'm hearing a lot of, Andrew, is we're waiting for clarity because we don't know which way to turn as it relates to our production, our manufacturing, our consumer confidence, and if they're going to continue to buy it while these uncertainties surround us. I have to think about a tipping point to, yes, okay, we can make it through this, we can get through this, we can get through, it's too late. When is that potential tipping point? What is our scale of we can go without oxygen for these many minutes? Second question is, you can be the strongest, most fit individual, but if you don't have food or water, you're done. I don't care how good shape you're in. If you're going to be battling a week from now with no food or water to continue to maintain your strength, you're going to be in a bit of a non-living environment in order to fight. That being said, monetary policy, the amount of liquidity in the system, M2 supply. If we don't have that oil in that engine and allowing that engine to move, what is your take as well, how it relates to that tipping point? Does the monetary policy, I know Brian Westbury's talked about it. I've done my own research. I don't see us being against the wall when it comes to liquidity. I think a number of reasons I feel that way. That's not important for this moment. I want to know what you think. And is there a tipping point?
Yeah, so let's go back to that first piece. Is there a tipping point? One thing to remember is a lot of countries, a lot of companies, we saw this company, Trump pre-announced that he was going to be doing a lot of this. So the Q1 GDP, we're going to get numbers later this month. How did the U.S. economy do during the first quarter? We saw a tremendous increase in imports, right? If you look at the import-export data, companies said, I don't know whether that number is going to be 10%, 20%, 40%, what it may be. Let's get a lot of that inventory, kind of like feeding yourself. If you stockpiled some of that food, not knowing how long you wouldn't be able to eat, how long you wouldn't be able to get new stuff in, it did give us a little bit of time. Now, it's a difficult question because when we think about, what those resources are, there's certain things that we are, I think, for the long term, going to rely on other countries for. I don't really see, to be honest, I don't see Nike putting their facilities, their production here in the United States. I don't think there's a desire to do some of that low-cost labor here domestically. There's reasons as nations are emerging. You look at Vietnam, you look at Bangladesh, right? You look at India, there's a lot of people that are moving out of extreme poverty. They're finding these opportunities that have, this is a big step up. This is a big advancement. We're more focused domestically on high tech. We're more focused on high production value, high margins. So there are some industries that would do fine. Tech industry, right, can make an easier time of sourcing some of that stuff domestically. We've already started with chips. We've already started on electricity. What's happened on the energy front over the last 10, 15, 20 years has had a tremendous impact in giving us some of that security here in the short to intermediate term. We already see some of the US companies on the auto side saying, well, maybe we're going to bring some of that production to places like South Carolina, to Michigan. We're going to move some of that activity to places like Texas. Where you're going to have the biggest difficulty is some of the food production, because there's certain things we just can't grow here. And so again, sometimes you make substitutions, but a lot of it is the things we don't think a ton about: the shoes, the socks, the pants, where what will happen because we don't just go without. This is the reality of it, is that if the price of a pair of pants goes up 20%, and instead of paying $50, you're paying $60, people will do that because you need to wear pants. So from a tipping point, I would tell you, if this goes on through the second quarter, so over the next 6 months, you're going to see a U.S. recession. Again, not a deep U.S. recession, but you would see a recession. If this went on through the end of the year, you're going to see more impact showing up in the unemployment rate, and that's going to bring the Fed into the fold. And this is where we get into these interesting questions. As you mentioned, right, the Fed is watching this from the sideline. They missed the boat. Okay, they told us it was going to be transitory in 2020. It wasn't. They told us inflation was going to be down to 1.7% at the end of 2021. Instead, it was at 7.0%. So I'll give them a little bit of credit because they got one of the numbers right. The 7 was in there. They just had it on the wrong side. They told us in 22 that they were going to raise rates 3 times and get inflation down to 2%. Instead, they did 17. they have had a tough time navigating because I believe they're working off the wrong models. We do believe that the money matters. When that money came in from the PPP loans, the direct stimulus checks, additional unemployment benefits, when we were flush with cash and spending more than ever before as a society at the end of 2020 with 10 million people not working, it was economic morphine. It helped us feel good for a little bit, but the real side effects of inflation were there. We're going to be watching the Fed because as the pressure builds, they're going to feel this increasing need to act, even if inflation isn't taken care of. We're sitting today 2.5%, 3%, 3.25% inflation, depending on what measure you use. They've historically prioritized employment. If companies are uncertain and they pause on hiring, they pause on investment, they pause on activity, if we start to see the unemployment rate rise, that is something that we would certainly watch for. They're going to look to put in liquidity if it comes time, but there is a risk that they're the ones that could push inflation higher. It's not the tariffs themselves, it's the overreaction that comes out of places like Washington from a misunderstanding of how the system works. It's a risk, it's a difficulty, and we will watch and wait and see.
I'm sorry, I was on mute there. You're saying that the overreaction potential of the Fed to lower interest rates or inject more liquidity or stop sucking liquidity out at the $25 billion clip monthly could be an actual mistake on inflation.
It could be. If you look back at the 70s and the early 1980s, right, we had the battle with inflation. Again, similar in the 70s, it was a lot of extra money that entered the system. It was a lot of overspending coming out of Washington. And when they paused, they put the brakes on, it brought inflation down, but it brought economic pain up. As you pulled yourself off the morphine, it was uncomfortable. And as we started to see the pain in the economy, the Fed had to make this decision. Are we willing to accept the pain to get the true reset? Are we willing to accept the pain of the withdrawal so that we have the freedom afterwards? And the Fed has historically, Congress has historically tried to avoid any short-term pain. And so, there's a risk that later this year we could see inflation start to reaccelerate, or next year. And that's more outside of the tariffs. But again, the longer that it goes on, and the more that the Fed feels they need to act to try to fix the situation, I think there's a risk as we progress later into this year that they could create another inflationary environment, not because of the tariffs, but because of their reaction and what they think they should do.
Two comments.
Yeah.
I appreciate that take. I'm not sure. I don't necessarily align to it because I don't understand it maybe as well as you, but I do know this. We have a enormous amount of treasury coming due for refinancing to the tune of $9 trillion this year alone.
Right.
And the rate that we were borrowing at when we originally wrote those notes was at a basically zero interest rate environment. We have a 400% increase based on the 10-year treasury today. I know that you would think common sense would tell you that the Fed, or at least our federal government, would like interest rates to come down. One would ask the question, why didn't you refinance when we had lower rates a few years ago? I don't know if it's worth asking because we can't do anything about it, but we are where we're at. Do you think that Trump or whoever is behind the scenes would like interest rates on the long term to come down further as they look to refinance? One question. Two, kind of a separate question. I've had some concern with China. We know that that's the partner that we have the most concern about. And one would say, well, what if they sell our treasury? My understanding is they don't own a lot of our treasury like they did back 10, 15 years ago, like very anemic amounts, much smaller than what people think. What's your comment on both of those topics, if you don't mind?
Yeah. So the first one, would Trump like to see lower interest rates? Yes. And the Treasury would like to see lower interest rates. I think the Fed would like to see lower interest rates. Is that what they're trying? Somebody asked me the other day, would Trump be willing to put in these tariffs, cause economic pain in order to cause some weakness, cause the Fed to cut? If that's the strategy historically, right, the activity that comes in, we have what are called automatic stabilizers. All of a sudden, unemployment benefits shoot up, and there are certain payments that get made. It would increase the deficit cost for this year because of those payments that just have to be made for things like unemployment. And historically, those extra payments, the extra budget that we end up spending more than offsets the gains that we would have. Now, why didn't we ultimately issue 50-year, 100-year? I mean, Argentina issued 100-year debt back in 2019 and 20. Argentina's never gone 100 years without defaulting. They barely go 7 years without defaulting. Why didn't we do it? Well, the reason that the Treasury said is they said, we don't think there's a large market for it. We don't think there's a lot of people that want to hold 100-year debt. Apple did a similar thing, 50, 100-year debt. Microsoft looked at this, right? They made a decision And it was a political decision. They chose to do shorter data because the way that it works for congressional budgeting is however much your interest payment is going to be for that year, that's what counts against your budget. So by doing 3-month or 6-month or 1-year issuances, they were able to keep down their spending and free up capacity to spend in other areas. It was a short-term gain for longer-term pain, the exact opposite of what they should have been doing. Now, so again, I look at that and I say, Trump would love to see it lower, but the way to get it there is to fix the financial, to fix the deficits, to show people that we're being fiscally responsible. That'll bring it down. That would have far more of a lasting impact. Now, the other question about what if a group like China, we wrote a research report on this. It was a little while back. The thing is, if China wanted to move off of the US dollar, which quite frankly, they don't. China has been talking about reducing US dollars, reducing US treasuries. If you actually look into the data that they produce, they say where they buy, their currencies from, where they buy bonds from, you see a net reduction in US purchases. But then you notice they have this big uptake in Luxembourg. And people are like, what in the world are they doing in Luxembourg? China can't be buying a bunch of Luxembourg debt. Luxembourg doesn't have that much debt. Well, it turns out Luxembourg is the European clearinghouse for US debt on the secondary market. So essentially what was happening is China was trying to find a back door to make it visually appear they were pulling back, but they weren't. But let's say they wanted to. Let's say China said, we don't want to do US dollars. Russia says we don't want to do US dollars. They have to sell it to someone. They can't just go to the US and say, hey, we're turning in all these 10-year bonds. We know we're 7 years too early, but we don't want them anymore, so you need to pay us. What they would have to do is find another buyer. And whether that was, Sweden buying it or England buying it or France or Germany, China would be the one that would take the loss. It really doesn't impact us in that short to intermediate term. If they sold those treasury bonds, it really doesn't impact us because it doesn't change how much we're paying out. It changes who we're paying to. The other thing that I really watch here is how much is the world relying on the US dollar? Is the world moving away from it? China says they're moving away. Russia says they're moving away. People ask me about BRICS currencies. People ask me about, what if Brazil wants to do something? Look at the actual flows. The Bank for International Settlement publishes the data. They're the clearinghouse between countries. If Brazil wants to do a trading contract with France and they're settling up in 6 months, they can choose whatever currency they want to do business in. And they choose the US dollar again and again and again and again. Right now, we're about 50% of all international transactions. The next closest is the euro, which is now a little bit below 20%. Then it's the British pound at 10%. No one else is close. Somebody brought up this question yesterday. Is the US dollar going to get replaced as the world's reserve currency? There is literally no one else that can step into that. We are the least dirty sock in the laundry. We got a little dirt on us. We're not perfect, but we are the least dirty sock in the laundry, the most reliable system. Our private property rights, rule of law, functioning democracy has created amongst the best growth, particularly the best growth of any developed nation. So I hear a lot of that talk, but in all honesty, I think a lot of it's overblown. I don't think China's going to be in decline here pretty soon. Population-wise, turns out a one-child policy is not good for growth. They are going to be in this decline phase. Russia is starting to feel some of this pain. I look out 5 years, 10 years from now, and while there's turbulence in getting there, I think we are very well positioned to be the world's leaders, particularly if we double down on what we're doing on the technology side. These other countries might throw fits. They might not love it. They want to be in that leadership position, but they don't have the resources that we do.
Excellent. Very good. Listen, I think at the end of the day, my take is we have to do what we're doing in many ways, even though none of us like it. It's like you want to have an outcome, but you don't want to do the work to get to the outcome. And we have to keep in mind that we were put on this earth to leave this earth a better place. And unfortunately, the path we've been on is making, I think, a directional, call it momentum that isn't aligned to that. And here in the United States, we are so fortunate. Myself, my kids, having the opportunity to have the American dream. And we want to make sure that we continue to be able to deliver that. And with the amount of spending versus income that we brought in as a nation these last several years, if not a decade, is the opposite of what, if I were running a business, would allow me to still be in business. Mm-hmm. So some of these things, the reset, as you like to refer to it as, and I know Reagan did, and I think we're referring to it as it sits today, whether it's up for debate as to whether it's the right reset, and I think we'll find out very soon. I believe the negotiation will take its course. I believe the negotiation will put us in a better situation. even in that middle ground, my hope and my prayer is that it goes quick and we get through it. Obviously, that's something we'll find out very soon. I think if we take a step back and we just say, what are we expected to do to make sure that we're able to make it through, whether it's a business or our personal finances, is maintain a level of liquidity relative to our fixed cost, that we have at least 6 months in a position where it's accessible, liquid, and then any money that we're going to need in the next 2 years that is in addition to that we have liquid. We don't have it in a position where it can lose, and maybe it's generating a little bit of interest or a decent amount of interest while it waits. And then any money that we know we're not going to need for 3 years or longer, we have the ability to take advantage of ownership of public companies and different areas and sectors and our areas of business, as well as you pointed out, some international opportunities for the first time in several years that make some sense. And having a diversified portfolio, and then doing something called dollar cost averaging, if you have the opportunity with current liquidity or income. Dollar cost average without human hands every month into the predetermined allocation that we discussed that meets your goals and expectations. I know sitting here today, we don't like to hear these things, but that's the way. 30 years of experience in leveraging folks like yourself and folks before you to understand how these markets perform and how much time it takes for us to get through the uncertainty and get back to higher ground. We're going to need that time to allow things to take their course. It may be much less, but it may be that long, and we need to make sure that we can sustain that. If you make it through this environment and you don't react in an emotional fashion, you will come out on the other side much better than you went into it. I've come to learn, whether it would be through the financial collapse of 08 and 09, whether it be through the COVID environment, whether it was from the dot-com era bubble that we endured, or the 9/11 terrorist attack. Every single example, if we would have made that approach, we would have come out on the other side better equipped and better positioned and worth more, and having the purchasing power prior. And you run your businesses the same way, virtually. And I thank you for you're excellent, Andrew. I got to tell you, this is the first time my audience has seen you. If you'll be kind enough and willing to come back, I'm going to have you as a return guest. And matter of fact, I try to keep these conversations within an hour, because I know how hard it is to give yourself an hour to sit still and listen like we did today. And I'm going to ask you, Andrew, some final thoughts for our audience that you would like to leave them with in this environment to help give them the assurance and the planning and the maybe expertise that you can lend to get them prepared for the next day.
Yeah. You know, one thing I wish we spent more time on, you kind of touched on this. If you go back and you look, I was sitting with my wife's grandfather the other day. He just turned 100 years old last year. Okay, 100 years old in October of 2024. He grew up in the Great Depression. He fought in World War II. He fought in the Korean War. He watched the Vietnam War. His kids fought in it. He went through the inflation of the 70s. He went through the race riots. He went through double-digit interest rates, had a mortgage at 18%. He went through the market crash in 87. He went through the dot-com bubble. He went through 9/11. He went through the housing crisis, went through COVID. And he's like, Andrew, the biggest lesson I've learned in my life? Turn off the TV. And he said, if you stop, we were sitting there, he had 17 great grandkids around him. And as he got up, or as they got up, he had a tear in his eye. And he's like, I could never imagined the world that they would grow up in. And he pointed me to charts. He pointed me to information. Here's a thought to leave yourself with. If you go back to 1963, 1963 was the first time ever in human history that more than half of the world's adult population was literate. We are closing in on 90% today. We've got more people with education, access to information. We have more access to information today in the palms of our hands than the president of the United States had 25 years ago. We've got better access to sanitation, healthcare. We are unleashing human potential in a way that the world has never seen. If you want to see what that result looks like, go look at global poverty rates. We have seen a tremendous improvement here. Those two lines move in absolute opposite directions just over the last 20 years. To put a number on it, we have averaged 125,000 people per day globally moving out of extreme poverty. We have disagreements. We have the tariffs. We've got, all these. We never have a day where everything's quiet. I can't think of a day I've turned on the financial news or the news in general in the last 10, 20 years where it's been universally positive. But if you step back and look, we are doing things we've never seen before. We are unleashing human potential. And that potential has historically led to tremendous prosperity. I've got a 10-year-old, a 7-year-old at home. I think over time, the momentum factors, the critical drivers that move us, that move the markets, that move earnings over time, the gears behind that have strong momentum now. If we can be patient, if we can watch, if we can tune out some of the negativity, we're participating and we're engaged in the market at what is truly an incredible time.
Gosh, beautiful. Thank you, Andrew. Let me just say this. There is 0 ounce of fiber in my body and my core that doesn't believe wholeheartedly that this market will fully recover and go to new highs. Zero chance that that's the case. The question is, how long is it going to take? And if we can stay the course, if we can do the right thing in the hardest moments, we're going to come out of this ahead. And I'm going to tell you, we're here at our firm here with partners like you, Andrew, with the all hands on deck mentality, with white gloves, here willing, ready, and able to help guide and counsel and answer questions. And I thank you, Andrew. I thank my audience. I promise you better days to come. We will come through this and we will be better from it. Thank you.